Gold isn't going up right now. It's being repriced aggressively, like the market just found out the fire alarm actually works. And the loudest voices trying to downplay it are leaning on the same old story that keeps people late to the trade. They'll tell you it's just uncertainty, just inflation, just another headline spike that fades when the news cycle moves on. But the move you're reseeing is being driven by something far less emotional and far more mechanical. And once you see it, you can't unsee it, because it changes what levels matter, what the next 2 weeks are likely to look like, and what breaks if the thesis is wrong. And yes, that includes the uncomfortable part. Why a 45% move in 2026 stops sounding like a meme and starts sounding like the market doing math. And the real pressure point isn't the headline, it's the plumbing. Right now, gold isn't behaving like a sleepy store of value that politely drifts higher when CPI prints hot. It's behaving like a scarce asset being pulled through a narrow pipe, where the pipe itself, financing, hedging, delivery preferences, and the futures curve, starts to matter more than whatever talking head is currently on screen. That's why you're seeing these sudden bursts, these fast runs, these days where gold feels like it's ignoring the script. Because the buyer has changed, the motivation has changed, and the market structure is starting to reflect that shift in ways that don't show up in a neat headline. Look at the price behavior right now, not the story. In just the early stretch of January, gold ripped from the low 4,300s into the high 4,800s, flirting with that $4,900 area like it was trying to decide whether to tag it once or make it a new floor. That kind of move in that time frame is not normal drift. That is urgency. That's the market saying, we don't want to wait. It's just duh. And when a market stops wanting to wait, you need to ask a very specific question. Who is paying the cost of impatience? Because there's always a cost. It shows up somewhere. And that's where the real signal starts. Here's what the mainstream explanation gets wrong. Uncertainty is not a mechanism. It is a label people slap on price when they don't want to explain why the price had to move. The real question is what the move forces participants to do. Because markets are not diaries. They're constraint systems. When something shifts, the participants don't vote with opinions. They adjust with risk limits, margin requirements, hedging models, inventory constraints, and financing costs. That is why gold can look calm for months and then suddenly move like it got yanked by a winch. It's not a mood swing, it's a constraint snapping tight. And this is the part most people miss. Spot price is the headline, but the curve is the confession. Gold is one of those markets where you can learn more from how the futures are priced relative to spot than you can from the spot print alone. Because gold, under normal conditions, tends to trade with a cost of carry structure. In plain English, the future is usually a little more expensive than right now. That extra price isn't magic. It's basically rent, financing costs, storage, insurance, the opportunity cost of tying up capital. In a typical world, you pay rent to hold gold forward. The curve is usually in contango. That's the default posture of a financialized metal. So when the curve starts compressing, when that rent shrinks, or worse, when the market starts paying up for immediate metal, the story changes. It stops being people like gold and becomes the present is being bid harder than the future. That's not emotion. That's scarcity, or at least the market pricing a higher value on immediacy. And when that happens, the paper market and the physical market start arguing with each other in public. Spot can be pushed around by flows, sure. But when the curve tightens, it's telling you that the market is either short convenience, short deliverability, or short patience. And that's where price becomes sticky on the way down and explosive on the way up. Because if you can't just roll forward cheaply, you're forced into decisions you don't want to make. Now, I'm not going to do the cartoon version of manipulation, where a villain twirls a mustache and pushes a button. The real world is more boring and more powerful than that. Incentives, balance sheets, risk, dealers, borrowing costs, delivery windows. And those incentives create patterns that look like suppression sometimes, not because of a conspiracy, but because the system is built to dampen volatility until it can't. And when it can't, the snapback is violent. But that's not even the most important part. The next detail is what flips the whole setup. The hidden detail, the underappreciated piece that reframes everything, is that gold S rally becomes a different animal when the cost of sourcing metal and financing positions starts to change faster than the narrative. Think about the plumbing behind the scenes. If you're a dealer or a bullion bank or a large participant making markets, you're not just buying a coin and putting it in a drawer. You're running spreads. You're hedging. You're borrowing metal. You're lending metal. You're rolling futures. You're managing collateral. The moment the economics of that system change, price discovery changes with it. Here's the clean mechanism. In a carry market, if spot rises, you can often sell the future, buy spot, and lock in a spread that pays for your financing and storage. Arbitrage keeps the curve in line. It's like a set of rails. but those rails depend on stable financing, stable availability, and stable willingness to lend. If lease rates rise, if borrowing gold becomes more expensive, or if the availability of lendable metal tightens, the arbitrage that normally smooths price starts to wobble. Suddenly, the curve doesn't behave. Spreads behave differently. Participants who rely on cheap roll-down or cheap borrowing get squeezed. And when participants get squeezed, they don't wait for confirmation. They reduce risk, they cover, they buy back, they pay up. And that ice, where the move stops being a slow grind and turns into a series of air pockets and thrusts. So what does that mean this week? Not in theory. It means you should stop asking, is gold overbought? And start asking, what is the market charging for time? Because if time gets expensive, if it costs more to stay short or more to carry exposure forward, then shorts become fragile, dealers become reactive, and dips become shallower than you'd expect. But that's still only one layer. Proof matters. Stack it. Proof point 1 is price behavior, the acceleration. A market that moves fast into a psychological level is telling you there is urgency or mechanical buying, not just casual allocation. Proof point 2 is institutional tone, the quiet pivot in bank research where targets stop being reasonable and start being scenario-based. You've probably noticed it. The language shifts from modest upside to upside skew, from base case to tail risk, from if inflation persists to if reserve behavior continues. Translation: the people who need to be careful with words are acknowledging that the buyer profile has changed. That's not bullish poetry, that's risk management. And it matters because institutions don't need to be loud to be heavy. They just need to be consistent. Proof point 3 is the nature of the buyer that doesn't flinch: central banks. Central banks are not day traders. They don't buy because a moving average crossed. They buy because reserve strategy changed. And reserve strategy changes when the world teaches you a lesson about what's actually yours. The last few years have been one long lesson in counterparty risk, sanctions risk, settlement risk, and the political nature of safe assets. If your reserves can be frozen, or if settlement can be politicized, or if your exposure is too concentrated in one currency system, then gold stops being a relic and starts being an option on sovereignty. That bid doesn't chase every tick, but it also doesn't panic sell because of a scary headline. It accumulates through dips, and it tightens the physical market in the background. And when the physical market tightens in the background, the paper market eventually finds out, usually suddenly. Proof point 4 is ETF and private flows. People love to dismiss ETFs as paper gold, but that's lazy. ETFs are a transmission belt between financial demand and physical sourcing. When flows are steady, they soak up inventory. When flows flip from outflows to inflows, they can become a surprisingly relentless buyer. And because ETF flows are often driven by portfolio allocation models, not feelings, they can persist longer than your patience. The market doesn't need 1 million retail investors to buy coins. It needs a handful of large allocators to decide that gold has become a strategic hedge again. And once those flows start, it changes liquidity. It changes dealer behavior. It changes how quickly dips get absorbed. But again, don't take one argument. Stack it. Proof point 5 is the global context and the paper versus physical tension showing up in the places where people actually take delivery or pay real premiums. When physical demand tightens, you often see it in premiums, in delivery times, in out-of-stock language, in the way certain regional prices lead others. Sometimes the signal is a regional premium that refuses to collapse even when spot pulls back. Sometimes it's the way wholesale bars move. Sometimes it's the way refineries and logistics become the bottleneck. Gold isn't like an app you can download. It has to be refined, assayed, shipped, insured, vaulted. Those are real-world frictions. They don't matter until they matter a lot. And when they matter, the paper market can trade 10 times a day. But the physical market can't teleport. That mismatch is where the pressure builds. Now tie that back to the forecast in the title: economic instability and gold up 45% in 2026. If you hear 45% and your brain immediately goes, that's clickbait, good. Skepticism is healthy, but then do the adult math. If gold is already elevated and it still has a credible path to another 45% in a year, that implies not just bullish sentiment, but structural conditions that keep demand persistent and dip spot. Conditions like reserve reallocation that continues, macro policy uncertainty that doesn't resolve cleanly, and market structure that forces short covering and dealer hedging at the worst possible times. That's not a promise. That's a map of pressures. Let's talk macro, but not the lazy macro. People love to reduce gold to rates down, gold up, or inflation up, gold up. Reality is messier and more interesting. Gold is a hedge against credibility risk in the monetary and fiscal system. Real rates matter because they change the opportunity cost of holding a non-yielding asset. But credibility matters because it changes what people consider a risk-free benchmark in the first place. If fiscal dynamics get messy, if deficits widen, if term premia rise, if politics makes policy lurchy, then the risk-free asset starts to carry more narrative risk. That's where gold gets its bid, even in environments where inflation isn't spiking. And you don't need the dollar to collapse. You just need enough participants to decide that concentration risk in any one system is too high. That's a slow burn until it becomes a fast move. And this is where the conflict comes in. The force trying to suppress or deny the move is not a secret committee, it's comfort. It's the institutional need to keep the world legible. It is the analyst who can justify gold is screaming because the system feels brittle, right, without sounding dramatic, so they hide behind neutral words. It's the investor who wants a clean trigger, a clean narrative, a clean entry, and a clean trend line. But markets aren't clean, and gold especially isn't clean when it's repricing trust. But that's not the part that matters most. The calendar is. Here's your why now trigger, the thing that turns a simmer into a shove. Late January into early February sits in a weird pocket where liquidity can thin, positioning can get adjusted, and options-related flows can amplify moves. And options matter more than people think, even in metals, because dealer hedging is not philosophical. It's automatic. When price starts moving toward large strike areas, big round numbers, heavily traded levels, dealers who are short options exposure often need to hedge dynamically. That means buying as price rises, selling as price falls, depending on the net gamma in the system. And if the market is in a zone where gamma flips, the flow can become reflexive. That quantity is how a market can feel like it, magnetized toward a level, because the hedging flows are pulling it there. And once it's there, the behavior changes again. Because if that one level breaks, the math changes. Let me make that simple. Imagine there's a cluster of options around a big number, say $5,000, because humans love round numbers and institutions love them too. If price approaches that level, some participants are positioned in ways that require hedging. If dealers are short calls, rising price can force them to buy futures to stay hedged. That buying pushes price higher, which forces more hedging, which pushes price higher. That's reflexivity. That's a gamma-driven feedback loop. It doesn't last forever, and it doesn't make price immune to pullbacks. But it can create those sharp stairs up that feel like the market is stepping over air. And if you're only watching headlines, you miss the fact that it's the positioning and hedging that's doing the lifting. Now, layer that on top of a physical market that's not as loose as people assume. If the curve is compressed, if the carry is not paying the usual rent, and if borrowing metal is more costly than the usual sell rallies, roll shorts forward, playbook becomes more dangerous. Shorts can be right on fundamentals and still get punished on mechanics. That's the cruel truth of markets. You can be right and still be early, and early can look exactly like wrong when margin calls show up. And when margin calls show up, the market doesn't care about your thesis. It cares about your collateral. That's why you need to think in scenarios and levels, not vibes. Because even if the big picture is bullish, the path will be violent. And if you're not ready for violence, volatility will use you for liquidity. That's not an insult. That's the job of volatility. It shakes out weak hands, forces emotion, and transfers. Positions from impatient to patient. The market is a machine that converts time preference into money. If you panic on every wick, you're feeding the machine. So here's the clean two-scenario lens for the next week or two, because this keeps us honest. Scenario 1 is the controlled pullback and retest. Gold tags or fails near that $4,900 zone, pulls back into a prior breakout region, think roughly the mid-4600s to 4700s, and then you watch how it behaves there. Does it find buyers quickly? Does it consolidate tight? Do dips get bought without drama? In a healthy bull, pullbacks feel annoying, not catastrophic. They grind, they frustrate, they make people think the move is over, and then they resume. Confirmation in this scenario looks like quick absorption of selling, stabilization above key prior support, and a curve that doesn't suddenly loosen as if the market is relieved. If the curve stays tight and spot holds structure, that's the controlled reset before another leg. Scenario 2 is the continuation squeeze. That's the one where gold doesn't give you the polite pullback. It chops, it holds high, and then it squeezes through the psychological level, $4,900 into $5,000, with a gap risk profile. And gap risk matters because when a level breaks in thin liquidity, the next price can be far away. If the market starts treating $4,900 as a floor instead of a ceiling, and if it spends time above it without instantly collapsing, you should assume the hedging flows and short covering can push it toward the next obvious magnet. The market loves to jump from one obvious number to the next when structure is strong and liquidity thins. But here's the discipline. A squeeze scenario doesn't mean straight line forever. It means probability of sharp extensions rises. It also means probability of sharp shakeouts rises. The higher it goes, the more it will try to throw you off. Now, what invalidates the bullish thesis in the near term? You need one. Always. Because without invalidation, you're not analyzing, you're hoping. Invalidation isn't, it went down today. Invalidation is structure breaking in a way that changes behavior. For me, a meaningful invalidation signal would look like a decisive break back below the last major support zone. Something like losing the mid 4,600s with follow through, combined with signs that the plumbing is loosening, the curve steepening back into comfortable contango, physical tightness easing, and risk-off dollar strength or real rate spikes that persist. Another invalidation cue is flow-based. If you see persistent ETF outflows returning and staying while central bank accumulation signals fade, that reduces the structural bid. It doesn't kill gold forever, but it changes the urgency. And urgency is what makes 45% moves possible. But let's not pretend there aren't real counterpoints. There are. Profit taking is real at these levels. Jewelry demand can soften if price runs too far too fast. Policymakers can surprise markets. A sudden surge in real yields can punch gold in the face. A global risk-off event can create a dash for dollars that temporarily pressures everything, including gold, even if gold eventually benefits as a hedge. And there's always the crowding issue. If too many fast money players pile in, the first air pocket can be sharp. The market loves to punish consensus at the worst moment. That's why you don't marry the line. You marry the process. Now let's talk about the emotional manipulation piece, because if you can't survive the path, the destination doesn't matter. If gold is in a structurally bullish regime, the market will still try to make you quit. It will do it with perfectly timed narratives. Gold is crashing as peace breaks out. Gold tumbles as inflation cools. Gold falls as yields spike. And then 2 days later, gold surges on renewed fears. The headlines will ping-pong to match the last candle, and if you let your brain treat headlines as signals, you'll be traded by the news cycle. The real manipulation isn't someone pushing price. It's the way volatility pressures you into bad timing. Big wicks down into support zones, especially around option expiry windows, are designed by the structure of the market to find stops, trigger forced selling, and hand the position to someone else at a better price. Even when nobody designs it consciously, the system produces that outcome. Because that's what liquidity seeking looks like. So here's the psychology shield. Separate trend signal from noise. Trend signal is structure. Higher highs and higher lows, strong closes, shallow pullbacks, consistent bid on dips, and plumbing that stays tight. Noise is intraday drama, wick hunts, and headline-based panic. If you're operating on a longer horizon, because a 45% year forecast is not a day trade, then you should think in weekly closes and key zones, not minute candles. You should size positions so that volatility doesn't force you to make decisions at the worst time. And you should decide ahead of time what would make you change your mind. If you don't pre-commit to a process, the market will commit you to one. Now, where does this all lead if the thesis is right? Not in a guaranteed return way, but in a path of pressures way. If economic instability deepens, whether that's fiscal friction, geopolitical tension, currency stress in pockets of the system, or just the continued realization that politics and economics are welded together, then gold remains a premium asset for credibility risk. If central banks continue reserve diversification, that's a steady background bid. If ETFs and private allocation flows continue to rebuild, that's an accelerant. If the curve remains compressed and financing remains tight enough to punish casual shorting, that's a mechanical tailwind. And if options positioning lines up around major levels during thin liquidity windows, that's the spark that turns tailwinds into sudden moves. Put those together, and you get a market that can plausibly grind higher. Then leap, then shake out, then resume. Exactly the kind of behavior that produces large annual percentage moves while psychologically exhausting almost everyone watching it. And I want to be very clear, even in the bullish case, gold can whip around violently. You can be in the right macro regime and still see a 5%, 10% downdraft that feels like the world ended. That's not a contradiction. That's the cost of admission. And the market will try to convince you the thesis is dead right before it continues. And when it does that, it tends to do it near the same places every time. Key support zones around options timing into liquidity pockets when sentiment is most fragile. That's why what to watch next matters more than what happened yesterday. So here's your near-term checklist. Simple, mechanical, and useful. First, watch the behavior around $4,900. Not just whether it touches it, but whether it can hold above it on a closing basis after it gets there. Touches are cheap. Acceptance is expensive. Second, watch the $5,000 zone as the psychological magnet. If price starts spending time just below it without collapsing, that's not weakness. That can be coiling. But if it repeatedly rejects with heavy selling and starts printing lower highs, that's a warning of a deeper retest. Third, watch the mid 4600s to 4700s as the most important near-term support zone in the controlled pullback scenario. If that zone holds and price stabilizes, that's constructive. If it breaks cleanly with momentum and no bid, the market is telling you the urgency cooled, at least temporarily. Fourth, watch the curve and the cost of time. You don't need to be a professional spread trader to understand this. If the market keeps paying up for immediacy, the bull is healthier. If the market relaxes back into comfortable carry, the urgency is fading. Fifth, watch flow narratives that actually move money. ETF, flow direction, central bank behavior signals, and the broader macro tone around policy credibility and fiscal stress. And sixth, watch the calendar. Late January into early February can amplify moves. Month end can distort flows. Weekend gaps can surprise you. Liquidity can thin at the worst moment. Don't let a gap convince you the thesis changed overnight. Verify it with structure. Now, about that gold up 45% in 2026 idea. The way to treat it is not as a prophecy, but as a stress test. Ask, what conditions would make that plausible? A continued structural bid, plus reflexive market structure, plus a macro backdrop that keeps credibility risk elevated. Ask also, what conditions would make it unlikely? A clear, sustained tightening in real yields, a return of strong confidence in fiscal and monetary coherence, fading reserve diversification, and a loosening of physical tightness that restores the usual rent to the future. If you can hold both possibilities in your head, you won't get trapped by narrative. And here is the subtle truth that separates the crowd from the professionals. The biggest moves are rarely announced. They're normalized after they happen. The commentary always catches up. The chart always becomes obvious in hindsight. What matters is whether you can read the mechanics while it's still uncomfortable, whether you can respect the risk without freezing, whether you can hold a thesis with an invalidation level rather than holding a vibe with a prayer, because the market does not reward certainty, it rewards preparation. So if you're watching gold right now and feeling that mix of excitement and suspicion, good. That's the correct emotion. Just don't let that emotion become your decision engine. Let levels, structure, and plumbing do that job. If gold holds high and tight, the squeeze scenario stays alive and the next obvious magnet is in play. If gold pulls back into support and finds a bid quickly, the controlled retest scenario becomes your base case. If it breaks structure and the plumbing relaxes, you respect that and reassess. That's what credible traders do. They don't argue with tape. They interrogate it. And if you are the kind of investor who wants to understand markets the way they actually move, through incentives, flows, and structure, not just headlines, stick with this style of thinking because it is the only way to survive the part where volatility tries to turn you into liquidity. Keep your eyes on the curve, the calendar, and the levels that change the math, and you'll be ahead of 90% of the commentary that shows up after the move is already old news.